Sorry, Emeka, thank you for letting me know. So yeah, I was on mute. I had the mute button on, I didn't notice. So once again, I would like to welcome you all. Today we have another technical analysis webinar. And as you can see in my slides, we are going to check together the average true range indicator, otherwise ATR. So if you're consistent with our website, you're checking our post and our analysis page, you can see that we are using it quite often. I mean, especially Stuart is using it a lot in his strategies. So today we're gonna go through to see what ATR is, how it can be used, how it could help you identify your entry point, your targets, and stop loss as well. Okay, so okay, there are a few people. Okay, so before we start, as usual, please let me know, like Emeka just did, let me know if you have any audio or visual issue, everything, any question that you have. Now is the time to stick in the question box. So I will try to cover all of your questions during the 1 hour session. If not, please email me at this email address, webinars@hopforex.com. So it's me, Stuart, or support team that we are handling that email. So we will reply to any question that you have. Okay, so don't hesitate to contact us. Other than that, we are also active in social media, Facebook, Instagram, Twitter, LinkedIn. You can message us anytime you want, okay? And then we'll try to help, okay? We are here to help anyway. So admin, I need to go through admin as usual. Okay, disclaimer. This material is provided as a general marketing communication for informational purposes only and does not constitute an independent investment research. Nothing in this communication contains or should be considered as containing an investment advice or an investment recommendation or solicitation for the purpose of buying or selling of any financial instrument. All information provided is gathered from reputable sources, and any information containing an indication of past performance is no guarantee or reliable indicator for future performance. Use acknowledge that any investment in leveraged products is characterized by a certain degree of uncertainty, and that any investment of this nature involves a high level of risk for which the users are solely responsible and liable. We assume no liability for any loss arising from any investment made based on the information provided in this communication. This communication must not be reproduced or further distributed without our prior written permission. It is warning, trading leveraged products such as forex and derivatives may not be suitable for all investors as they carry a high degree of risk to your capital. Please ensure that you fully understand the risks involved, taking into account your investment objectives and level of experience before trading. And if necessary, seek independent advice. Please read the full risk disclosure. So admin is now out of our way. That's me. You can see me as well. We're starting giving webinars with the camera on. I don't know whether this is more helpful for you or not. I don't know if you prefer this way, but yeah, I think with this way we have a more direct communication. So it's me. I'm here to help. I have nothing else to say really. Just you can ask me anything you want. I will try to help. With your to help you understanding the market, help you understanding any technicals. Okay, so don't hesitate to contact us. Okay, so that's it. Average true range. Let's start. So today we're gonna go through. As usual, I like posting the history of ATR, how it was invented, the background in general. So what is it? A bit of mathematics as well. I mean, how this indicator it has been created. What are these values that we are seeing? Where are we taking these values? So I like having a bit of mathematics at the back, just for better understanding how we could use it. That's the main topic. I mean, You might not care about the history, you might not care about how we are getting these values. What you do care, I'm sure, is that how you could use it in your daily trading strategies, okay? How you could benefit from it. So some ATR settings in different periods, time frames, etc. Whether it works or not, so the advantage and disadvantage that the average true range has, and also some examples for better understanding. So let's go through. Okay, so background of ATR, of the average true range, and how it can be used. So first of all, I would like to say that this indicator, okay guys, is not, sorry, okay. It does not provide, it's not an indicator of price trend, okay? The indicator does not provide an indication for the trend of the asset. It simply gives us the degree of price volatility. So it is a volatility indicator. It gives us an indication how the volatility, the level of volatility in the market, okay? So just to be clear, doesn't give you direction of the trend. It gives you level volatility, whether the volatility is high, low, neutral, okay? So it was invented by Wells Wilder, okay, as many other indicators, to be honest. Just let me, because I'm struggling here with my screens, give me just 5 minutes, not even, just a second. Okay, so as I was saying, okay, so it was created by Wells Wilder. So it's a volatility indicator, so it's not directional. You need to stick that in your mind because it's very tricky, because you might confuse, you might see indicators sloping higher, and then you can say, oh, it's moving higher, so I should get in as a bull, I should open a long position. That's not the case, okay? It's a non-directional indicator. The only thing that gives you is volatility. So it quantifies for you how much the asset is likely to move on average over that particular period of time that you're using. So let's say that I'm in an hour chart, okay? The average true range will give me, if it's going up, okay, well, it's like saying to me, there is a high volatility in the market. So if you check your chart and if it's moving upwards, then this might continue for some time to go higher. If it's going lower, then it will continue for in the near future to go lower because the volatility is high. If the volatility is low, then it means that you know what you're actually seeing right now, either it is long or short, it will not last for long, okay? So be very careful, okay? It's not a directional indicator. It gives you whether the volatility is high or low. So, okay, we'll see examples anyway, so you will learn how to read the average true range indicator. In the meantime, okay, just few mathematics, because I like posting some mathematics. I'm a mathematician after all, so just to see how the average true range indicator actually gets calculated. So first of all, it looks like this. It's just a line at the bottom of our chart, going up, down, sideways. It's just a line. Okay. So it's also is not in a particular range. Okay. So ATR, what ATR is, okay, is us actually decompress, okay, the entire range of the asset price for that period. Okay, so it's a kind of it's actually that line that I just showed you, this one. Okay, this line is actually a moving average, a smoothed moving average of our actual asset price movement. So it's a type of smooth moving average of the true range values of our asset. So just to give you an idea, the traders are using it as an idea of how far an asset price is expected to move on a daily basis, hourly basis, minute basis, up to your preferable time frame. Okay, so initially, however, like at the very beginning when it was developed by Wilters. Actually, Wilters created because he wanted to use it in a daily time frame. So Wilter actually recommended the 14 period, the 14 days. You can see here the 14 days smoothing. So, but this depends on your approach and strategy. Okay. Okay, of course, it was created initially for a daily chart, but that doesn't necessarily mean that you cannot use it intraday. Okay, in your particular trading style. Okay. So to understand the indicator better and how it is calculated, we can see over here how it is actually what's behind the indicator. Okay, so what we need to find out first. Okay, just I will not spend time on the formulas. It's just I will briefly explain what why I have posted these formulas on this on our slide. So what you need to find. What you need to find out first is the true range. So the true range is taking into account, first of all, the current high level, okay, of our period. If we are in a daily chart, let's say, okay, we are taking the current high value minus the previous close. So today is Wednesday. The highest, we're taking the highest value of the day minus the closing price yesterday. Also, we're taking into account the current low value of the day minus the previous, the closure value of yesterday's session. And also the high price minus the current high price minus the low high price. So by taking these three into consideration, the true range value is actually the one of those three that is the largest one. Okay, that is what this formula is for. Okay, taking the current high minus the previous close, the current low minus previous close, the current high minus the current low, and the true range will be the highest value of all these three. Okay, once the it doesn't really matter whether this value is positive or negative because we're taking the highest absolute value for the calculation of ATR. So these values, this TR value, this true range is like calculated every day or in every period depending on your time frame. Okay, and then we calculate the average of all these values taken. So what we are seeing actually in our charts, okay, and I'm referring to this one. What we are actually seeing in our charts is the average of the last 14 days periods, depends on your time frame. So it's the average value of the past 14 days. Okay, this is what ATR is for. It's giving you the average over 14 time periods. So every day we have a new value. Okay, we have a new value. So this is plotted in a line chart. Okay, this is just the months. You don't need to do all these calculations. I just wanted to give you an idea of what you're actually seeing in your chart. What's that value? That value is the average of the past 14 periods. The past 14 hours if you are in an hourly chart, the past 14 days if you're in a daily chart, the past 14 weeks if you're in a weekly chart, and etc. Okay, so that's why we're saying that the average true range is then a moving average, generally using 14 periods of the true ranges. Okay, so just a bit of a history. It was originally designed for commodities, but it can be that is what at least Welles Wilder credited for, but it can be applied in stock market, it can be applied in the currency market as well. Okay, so since it doesn't actually, it simply subtracts since the true range of the ATR are actually calculated by subtracting the prices of an asset, so it doesn't really matter. It can be used in any single in any type of market. So let's move on. That was a bit of a background, just a taste of maths, let's say. Okay, yeah, we have already covered that. Is the formula, and actually I have a simulation of the formula over here. So it's how the true range is has been calculated. So you can see over here the current high. This is in candle. These are candlesticks. So taking the current high minus the previous close minus the current low, the current high minus the previous close, and whichever is higher, it's the largest, we're taking it as the true range number. So just for you to be aware of. So yeah. So as I was saying, we just originally developed the average range for commodities, but we can use it in stocks, indices, and currencies. Simply put, okay, an asset experiencing a very, very high level of volatility. So if we are seeing ATR going higher and higher, okay, we're seeing this line. So watch a bit my arrow over here, my mouse. So if we're seeing ATR moving higher, that means that our asset, the asset that we are checking, is experiencing a high level of volatility. While if the ATR is moving lower and lower, okay, then that means that the asset is experiencing a low volatility. Okay, so what that means. So what that means, if we're seeing ATR moving higher, okay, and we're seeing actually the range of ATR also increasing, that suggests, okay, that the traders, the market participants on that particular asset, on that particular market, are prepared to continue moving on the same direction. So if they are, if we are in an uptrend, let's say, if our asset moves higher, and at the same time we are seeing a higher the volatility to increase, then that means that the market participants at the particular market are prepared to continue to bid up the particular asset through the course of the day. On the flip side, if we are seeing the ranges to get lower and lower, I mean, we've seen a decreasing range. So okay, so they are moving lower. That suggests waning interest. What that means, it means that the market participants are not really keen to continue investing in that particular market. So the volatility is low, it increases, so it's safer to, let's say, to avoid placing trades, because a move towards the profit is less likely to happen. People are weighing their interest for that particular asset, so we might see a bit of a choppy movements or reversal, or if not a reversal. So also, sorry, I missed something. I mentioned that in case that we have volatility increasing, then that means that traders are prepared to continue to bid up an asset through the course of the day. That is in case that is in if we are seeing our asset price moving higher. On the flip side, if our asset is moving lower, but we are still seeing volatility increasing, then that means once again that means that the market participants are prepared to continue sell down an asset through the course of the day. Okay, so even if we are in an uptrend or in a downtrend, high volatility is the chance of a large move occurring that increases profit. Okay, that increases the profit is higher. Okay, so you can use it in either in an uptrend or in a downtrend, because as we mentioned, it's a non-directional indicator, so it quantifies for you the volatility that there is in the market. So let's move on. Okay, over here, multiple uses for traders. So it can be used either to ATR could be aided in the placement of orders or calculation of position size, or it can also be used as a trailing stop loss. Okay, we'll have some examples for this for what I mentioned over here. So let's move on. So okay, before I go through the next example, just to mention over here that by saying that, sorry for that, it aids in the placement of orders. So for example, if we are seeing ATR, okay, you can see ATR at the bottom of this slide, okay, how it looks like. So if we're seeing the current value of ATR to be at 100 pips, let's say, okay, this is counted in pips, of course, and the trend that we are currently observing has already exceeded the 100 pips, then the trend has a higher probability to reach to an end. So you need to check ATR along with the actual price movement, okay? Whether this already happened, if that already happened, if it already the asset, the price has already moved 100 pips, then that means that he already moved. The trend's likely to reach an end because you already covered those 100 pips value. Also, as I mentioned over here, it can be used also for trailing stop loss. So there are many market technicians that they use ATR in order to enter and exit trades. It is a very, very useful tool to add to trading system as well. So because it was created actually to allow traders to move accurately, if I can say, to allow the traders to more accurately measure of the daily volatility of an asset by using these simple calculations. And yeah, trailing stop, it could be used for just setting your trailing stop. It can be used as an exit method, as I could say, either for a stop loss or on target as well. So let's move on. So how it could actually be used, like in the market. So here we have a dollar-yen daily chart. Okay, so first of all, okay, I don't know whether I should zoom in a bit. So we mentioned stop loss, target, and entry level. So first of all, you need to know that it's mainly used in order to set your target and stop loss. Okay, so ATR allows you to place your stop loss the maximum distance away in order to avoid any market noise that could actually hit your stop loss and then move at the direction that you actually wanted. So it allows you to set your stop loss at the maximum distance away in order to avoid that market noise, and using by using a shorter stop loss. Okay, it's also useful, as I said, to place your target, because it allows you to place your targets in a comfortable distance. Again, in order to avoid the market noise. There may be some economic data announcement, or I don't know, it might be a statement from one of the major central banks that could actually cause volatility, high volatility in the market, and it might either hit your stop loss or target if those are set too close to your entry. So ATR allows you to put your stop loss and target in a more appropriate level. Okay, so let's start. Here I have an example of a short position actually. Okay, so we have seen that the dollar-yen over here, it was moving lower for 7 consecutive days, and the same that coincides with the ATR as well, which started flipping lower and lower until it reached the 0.39 area, which that means 0.39. It means that the price moved by 0.39 cents. Okay, 0.39 pips in that particular example. Okay, on average, this is how much on average the price moved lower. So it's the average price move per price bar, per candle, because in this particular case it's daily candles. So the reading that we are seeing over here is this 0.39 is 39 pips. So after this, so what actually ATR is showing us in that particular example is that the asset is moving by 39 pips in average per day. So this decline of the dollar-yen, okay, along with this big bearish candle and the gap afterwards, is like tricking our attention for a possible further decline, because we are already in a downtrend, right? For 8 consecutive days, the asset is posting lower lows. It's moving lower and lower and lower and lower. So, sorry. So, point number one, we are in a decline. So the direction is on this downside. We have a downtrend. So we are thinking of opening a short position. ATR suggests an average move of up to 39 points. This is where you just check your chart, check where is currently the ATR, and you can see that it's at 0.39, which is 39 pips. As I was saying, the candle, the last daily candle closed bearishly, so we have a strong bearish candle over here. So it's bullet point number 2, and bullet point number 3, which is the next consecutive day. It closed, it did open with a gap further to the downside. Okay, strengthening this bearish outlook for dollar yen. So what that suggests is that we could enter the market short, with the next target being set 39 pips below our entry. So as I'm saying at the bullet point number 4, target is placed by using ATR at 39 pips lower than closing. So this is what that suggests. So an entry point could be the next consecutive day, the open price at the next consecutive day, and the first initial target could have been set 39 pips lower than the open price. While on the flip side, stop loss could actually be set 39 pips above our open price. Okay. So, excuse me. So that was that is an example how you could use in a short entry the ATR for setting your initial target and your stop loss. Of course, stop loss and targets could be set on multiples of ATR. So for the stop loss, in my opinion, you need to also consider your risk and reward, the risk and reward ratio that you wish to have in your trading strategy. So if you want to, let's say, flip to another example actually. So as I was saying, the targets and stop loss can be also multiples of ATR. So you could set your, if your risk and reward could be, let's say 2 to 1. So you want to take a profit double on what you're risking, then you could set your target 2 times away from what the ATR is suggesting to you. So 39 and 39, that's 78. So you could set your target 2, let's say 78 pips below your entry point. Okay, so so the multiples of the fraction of the ATR also works properly. So you need to consider as well the risk and reward ratio that you wish that you're using in your trading strategies. So that was regarding how to set in a short. That was an example of a short position. Now, okay, I'm seeing some questions. Maybe I will go through the whole. Let me open questions first. Please, will the difference of this webinar be on? Yes. Okay. Iodeji, it's always our webinars are always recorded. So since you have to leave now, it's okay. We'll send the recording to you as soon as we're done. Okay. So don't worry about it. So Onissimo is asking, is the ATR scale reading dependent on asset or it's interpreted one way? Enlighten us on converting readings to pips in all scenarios. I'm not quite sure what you're asking, but what I can say that ATR, it is of course dependent from the asset, because it's deriving its values from the price movement. Remember, is the average true value of our price movement the past 14 days, let's say, if our setting has been set at 14 period time frame. So it's the average value, okay, of the past. Is a smooth and average value of the past 14 periods. So it's based on the historical price of that particular asset. So of course it's dependent from the asset price. Let me, okay, is it the same for different pairs? Yes, of course. So let me check here. I have Aussie dollar, I have US oil. So don't worry. Yes, we will check other examples as well. You can be used anywhere, as I already mentioned. Commodities, currencies, stocks. Don't worry about that. It could be applied in every single market. Okay. So you have another question. Let me check. Just check. So okay, so enlighten us on converting readings to pips in all scenarios, as Onissimo is asking. Okay, for example, okay, this is a dollar yen pair. So dollar yen is actually calculated in 2 decimal place. So the fact that we are seeing ATR at 0.39, that reflects to 39 pips. If let's say we are in a euro dollar currency, which is interpreted in 4 decimal places, okay? So a reading in the euro dollar of 0.025, the ATR, that suggests 25 pips movement. Okay, we'll check the examples. Then let's check the next example. Okay. Okay, the next example is again in dollar yen, but the very next one is Aussie, so don't worry about it. Okay, so let's move on. How ATR can be used for trailing stop loss. Okay, again, we mentioned that other than tracking, you can also place your stop loss the maximum distance away, okay, in order to avoid the market noise, as we already mentioned. So, but you can also use it for trailing stop loss. Okay, so a trailing stop loss. First of all, does anyone know what trailing stop loss is? Yeah, of course you can get a recording of free. Don't worry. Don't worry, Mega. We are doing it right now. Okay, so don't worry about that. I don't. Okay, so trailing stop loss. Okay, trailing stop loss generally is a way to exit a trade. So let's assume that you are taking a short position. Okay, you are taking a short trade like this one, and the price is decreasing, it's going lower and lower as you expect, right? So a trailing stop loss will get you out if the price rise by a certain amount, of course. So in other words, the trailing stop loss reduce the risk and locks your profit as the price moves in your favor. So ATR is actually commonly used as a trailing stop loss. So at the time of the trade, okay, look at the current ATR again, the current ATR reading again, and you can place a stop loss at the multiple of the ATR. So two multiples of 2 of the ATR reading are quite common multiple for placing your stop loss. So let's say, now let's take that for example once again. Here we have a decline, we have a clear downtrend, okay? So we have opened a short position, okay? So we have entered a short position. We have to set our target and stop loss level, right? So you can set your stop loss either where, so if let's say that the ATR is saying to you, if ATR is at 10 pips, then it's like it's saying to you, you know what, set your stop loss 10 pips above your entry. Or you can set it at multiple times, at the multiples of the ATR. So the most common, as I mentioned, is twice. So 2 multiples of ATR. Here I have this in my bullet points over here. So you can set your stop loss 2 times of the ATR. So it's like I will set, if I am in a short position, I will set my stop loss 2 times above my entry. So if the ATR, let's say it says 10 pips, then I will put my stop loss 10 multiplied by 10 is 20. So I will set my stop loss 20 pips above my entry. Okay, this is what we mean. Placing a stop loss at a multiple of the ATR. So the 2 is very, very common multiple, meaning that you can place your stop loss at 2 times ATR above the price if you are in a short position, or below the entry price if you are in a long position. Okay. So yeah. So this way, the trailing stop loss is reducing the risk for you and or locks you the profit as the price is moving in your favor. As I was saying. So trailing stops is like adjustable. So as the price moves, okay, in your favor, then so if let's say if we're in a long position, okay, like over here, okay, let's say that we have entered on this rebound and we have entered a long position instead, okay. So if we are moving long, if we have opened a long position and the price is moving in our favor, so it's moving upwards as well, so we continue to move, continue to move the stop loss to 2 times of ATR below the price. So as the price moves higher, we could continue moving higher the stop loss. This is why it is a trailing stop loss, okay? The stop loss only ever moves up, not down, so it continues moving up as our price moving higher as well in our favor if we are in a long position. So once the trailing stop loss is moving up, it stays there until it can be moved up again, or the trade is closed as a result of the price dropping suddenly and hitting our trailing stop level. That's why we are saying that it reduces the risk because it's moving along with the price, and locks the profits for us. Okay. So the same process works also for short trades. So the stop loss is only moving, is only moved down as our price, as a price is moving lower again. So it's moving along with the actual price of the asset. So I have an example over here because I think it's quite difficult to understand just by verbally. So, okay, concentrate on this part of the slide. There is my example. Okay, to understand what is a trailing stop loss, how it could be set, and where it could be set according to ATR, and why we are saying that it reduces risk and locks the profits. So here's an example. Let's say that okay, that doesn't comply with this chart, but just concentrate on the on this written example over here. Okay. Okay. So as I was saying, let's take, for example, that we are in a long position, okay? In a long position, where our price is moving higher, okay? And let's assume that we have entered the market at $10, okay? And the ATR is also at 0.10, so it's like 10 pips. So we could place our stop loss either at 9.90 or at multiple times of ATR. So let's take the 2, okay? 2 times the ATR, which reflects to 20 pips, right? So we could place our stop loss 20 pips below our entry. So that is at 9.80. Is that correct, guys? Are you okay so far? So are you okay? Why we have set our stop loss at 9.80? Anyone? No? Yes? Come on. This is not actually a trailing stop loss webinar, but it's an average true range, but why not cover that as well? Are you okay? Did you understand why I have set my stop loss at 9.80? It's 2 times the ATR value, just to be still confusing. Okay. Okay. Actually, let's take an example from in the actual MT4 chart. Okay. So let me clear everything. Delete everything. Okay, that's okay. That's FTSE 100. So that's a FTSE 100 chart. Oh. Let's add the ATR over here. ATR. Let's drag and drop ATR in. Okay, so let's focus on this, on the decline that we have seen back in July. Okay, this is a daily chart. So we had 1, 2, 3, 4, 5 consecutive daily bearish candles. So once we have spotted this continuous decline, okay, we have 1, 2, 3, 4, actually, could enter from here, 4, so three black crows, 3, daily candles, negative candles. Let's check what ATR, what ATR is pointing to this bearish day. This third bearish day. ATR is at 90.8. Okay, so we could enter short. Okay, so first of all, we could enter the market at the next consecutive day in the open price. So the open price is at 7500s. Okay, the ATR that particular day was at over here 90. Is it? Sorry, here we are at let me stick the box over here. So it should be 87. Sorry, it wasn't 90, it was 87. So that particular time, that particular day, ATR was at 87. Let's put the line as well so you could see it as well. 87. I have entered the price the next consecutive day at 7500s. Okay, so I'm taking a short position because my asset is in a decline. Okay, you can see it's in a decline. I'm taking a short position at 7500s. Here is my entry position. You can see it in this red line. ATR is at 87. Okay, so now I have to decide whether I will set my target, where I will set my stop loss. Okay, I will place my stop loss either 87 pips above my entry or at the multiple of the ATR. Okay, so let me do the maths. 70, my entry was at 7500 minus 87, so that should be that my so not minus, it should be plus 75 because I'm in a short position. So my stop loss could be either at 75.87 or so it could be either here or at the multiple of ATR. So if let's say if I put my stop loss 2 times of the ATR above my entry point, then that should be around, so 87 multiplied by 2 is 174. 174 pips above, 174 pips above my entry, then that should be at 76, 70, 76, 74, 76, 73, so it will be somewhere here. Okay, okay. So you could either set your stop loss where the ATR is pointing to you, so 87 pips above the price, above your entry, or 2 times the ATR above your entry. Okay, so 2 times is over here. So stop loss could be either here, or if you want 3 times the ATR, but this is quite far away of the entry, so it will detract your potential profits. So don't overdo it, okay? Don't set your stop loss way higher. That tax your profits and increase your risk. And the target, okay? So we have set our stop loss, okay? And so we have set our stop loss. We have actually a trailing stop loss. So the stop loss is now moved. So as the asset is moving lower, okay, let's say that the asset has moved by okay, the next 2 days. Okay, let me change the color a bit. Blue. Okay. So no, it's not visible. Let's height. Okay, here we are. Okay, the next day the asset moved down further, and actually it moved down to 71, 72, up to 71.60. Okay, up to it moved down to 71.64 area. So as the price declined and went down to 71.64, okay, the ATR remains at the asset, actually the ATR, oh sorry, so the ATR right now, the next day that our asset drifted lower to 71.65, the ATR moved, currently is at 103 pips, okay? So, which is 2 times, so now that we have the stop losses should be moved down as well, 2 times of the ATR, so that suggests nearly 200 pips lower. So we need to shift our stop loss lower in order to lock the so far profits that we have. So, okay, so I set my stop loss 2 times above the ATR initially. So now that the asset moved further lower, and we need to shift it lower down to, we found 363.64. That is my new stop loss. Okay, with this way I have locked the profits that I have so far. So in case that the asset moves against me and hits my profit, I have already taken some profits. This is what we mean by locked profits. The trailing stop loss, sorry, the trailing stop loss is moving along with the trend. So it locks profits. It reduces risk in case that the asset moves against you, but it locks the already taken profits, the ones that you already gained. Okay. So so the price is moving lower. It moved down to 71.64. The stop loss has moved lower as well, along with the price and according to what ATR suggests. Okay. And with this way, we have locked the profits that we have gained due to this further decline of the price action the next consecutive day. Is that clear, guys? Hopefully it is, because we are nearly at the end of our session. So, okay, cool, thank you. Okay. Anyway, you can just email to us or send us a message or something if you have anything else to ask, okay? But I'm glad that Gonfrey and Emeka have understood with this example what trailing stop loss is and how you can use ATR for setting your trailing stop, for setting your stop loss, your target, etc. So let's move on. Just quickly to see possible ATR settings. So as I mentioned, Reader has used 14 days originally. So the default setting for ATR is at 14 periods. Of course, you can modify that. Okay, as I'm saying, in every single technical indicator that we are showing, you can modify the settings, but check whether it satisfies. It coincides with the price asset. I mean, if the price of gold is showing, let's say, I don't know, it's in a downtrend, a very sharp downtrend, and your ATR, you have changed your ATR and you have set it at 7 days, 7 periods instead of 14, but it gives you reading that they are not coincide with the price asset. So what I mean, Okay. First of all, you need to know that if you change the settings to higher ones, so the default is 14, if you set it up to 28 days, 30 days, etc., then you might have more reliable signals, but it might be late signals. So you might miss the opportunity because it already happened. If you change the setting to shorter ones, tighter ones, you might have faster signals, but it might be proved non-accurate ones. Okay, so take care when you're changing the settings. So you need to always to check whether the settings are logical and whether they are satisfying your trading style. Okay. So let's take, for example, in this situation, my ATR looks just fine. But in case that someone decided to change it, and it changed the ATR properties from 14 days to, you know what, they said, I want faster signals, so I will set the ATR to 7. Okay, check, does it give you correct signals? Is it going indeed? So I have seen this decline and ATR is moving higher, so that suggests high probability. We are okay so far, but did he indeed moved by 87 pips that day? Let's measure. Okay, it moved at the multiple of ATR 2 times. It moved 166, so that's fine. It seems that for FTSE 100 daily chart, the 7 period works quite well. Let's say that, for example, that was a big candle. So that candle was 230 pips. What the ATR is saying to us that day, it was at 112 multiplied by 224. That's fine. That's good. So it seems that for the FTSE in the daily chart, ATR with period 7, it works correct, but that will not always be the case. So take care when you're changing the settings. Take care that it gives you logical signals. Okay, so let's say if I shift it to the hourly chart, is the hourly chart works okay with the ATR with period 7? Let's see, we have an incline over here, but the ATR has stuck to 29 area. So did I have it moved? Moved 27, it moved 28 pips, it moved 25. That's a bit risky. Let's change it to 17. Okay, indeed it moved close to the ATR, but some days it didn't move close to, some periods it didn't move close to the ATR. 14 days, 14 periods. So on average is moving by nearly 30 pips again. 25, no, that doesn't satisfy that. Let's say 5. Okay, 28. Oh, 20. So the candle will be 27. That day is 28. And our ATR is at 28 as well. So that satisfies it. Always check your settings, whether they are giving correct signals. In my humble opinion, check the default settings first, because usually they work quite well. There might be no reason to change it, unless if you're a minute trader or a 15-minute trader, then you might need to change it. But check, always check. Always combine ATR with other indicators. If you don't want to combine it with other indicators, check closely your candles. Okay, their body, whether it's big or not, their tails, whether you can see a clear trend. Okay, don't just be blind and check the ATR, just only the ATR. Investigate, monitor your trend. Just confirm that you indeed have a trend. Okay, indeed you can see a clear downtrend, a clear uptrend, or 3 consecutive daily candles to the upside, 3 consecutive daily candles to the downside, a break of support and resistance, etc. Okay, let's move. what we have over here. So, okay, this is an example when we are changing the settings. So in the first chart, you can see that we have changed the settings to 20 period ones. So it gives you smoother trend line, ATR line, more reliable results, but you might miss the opportunity to enter the market on time. While on the flip side, we have detected the ATR to a lower setting, and that gives us a choppy ATR line. So we actually might have some not so accurate results. Okay. Okay, just summary. ATR presents how volatile an asset price has been over a specific period of time and helps traders predict future price volatility. If it is used to place risk management orders. Okay, so typically you should use bigger stop loss. Okay, when the price ATR is high, smaller stop loss when the ATR is low. Why is that? Because if the ATR is low, then that means that in the very, very near future, like the next few hours, the next few minutes, the asset might reverse. So in that case, the stop loss should be very, very close to your entry. Okay. It will not provide information on price direction. Okay, so you should check your chart to identify the price direction, whether you can see clear downtrend or an uptrend. So it will not provide information on price direction, entry points, or whether the price is trending or trading sideways. But it can help you to set your target once you have entered the market. Changing the ATR setting from the standard 40 periods will affect the indicator sensitivity. So hopefully you're okay so far. Remember, setting your target at the multiple of ATR once or at the ATR number or twice the ATR number, and putting your trailing stop loss the same at the opposite direction, either at the ATR as the ATR number is giving you or twice the ATR number. And you can use it also with trading stop loss, so trailing stop loss. So the trailing stop loss moves to it's when the stop loss is moving along with the price. So if the asset moves against you, you would be stopped out, but you will already have taken the profits that you have gained from the initial entry, from the initial stop loss target. Yeah. So an indicator that I could suggest to be combined with ATR is Parabolic SAR. Parabolic SAR are these stop and reverse bullet points that you can see over here, because it's a trending indicator, so it can indicate you the direction of the trend. So it could be combined with the ATR indicator. So as you can see in this illustration here, the Parabolic SAR gives you the price direction, and ATR gives you the volatility of the actual asset. So those two are they could combine quite well, okay, because the one can indicates you the direction, and the other one indicates you how long the volatility. Okay, so yeah, that's one of our suggestions how you could, in case you want to combine ATR with another technical indicator. So we have reached to the end of our webinar. Okay, so now is the time. I will just call for your questions. Now it's the time to stick them in the box, and I will wait just a few seconds for you to post any question that you have. In the meantime, I will present, or just going to present technical technical indicator basics. Let me just put it here. So, okay. So as I was saying, Otto is gonna present technical indicator basics. So it will discuss actually the purpose of technical indicators, the difference between the various indicators and the dangers when using them. We have also live analysis next Tuesday. The day after, we have trading intraday using pivot points, and how you can use these pivot points in different time frames, and how effective they can be. Also parabolic, okay, we have parabolic stop loss in reverse, the parabolic SAR indicator, the one that I suggest you to be combined with the ATR. So Otto will present a parabolic stop and reverse webinar on the 24th of October, but he will combine it with average directional index. But he will go through the pros and cons of parabolic SAR, the pros and cons of ADX, and how the DX is calculated. Another live analysis of the 29th of October. The day after, we have momentum reversal strategy. So what it is a trading strategy, what is momentum reversal strategy, and how you could use them in your daily trading and intraday trading. Last webinar for October is the scalping strategies from Stuart. So Stuart will explain what scalp is and some of the benefits and drawbacks of this approach to trading. So that's our forthcoming webinars. I have no questions as it seems. Okay, Godfrey, if you go to, let me show you. If you go to our main website, okay, click on the, click on the education tab over here, webinars, and you can see all of our forthcoming webinars. You can actually register on the ones that you are mostly interested in. Okay, so yeah, this is how you could register for our webinars. So thank you for attending. That was the end of our webinar. Thank you for attending. Hope you are having a great day ahead. Take care and see you again next week. See you. Bye-bye.